Going into 2022, the UK economy now has to deal with the first rise in interest rates in more than 3 years. It's a 15 basis point rise to 0.25%, and it was an 8-1 vote, so it was fairly convincing. But the big question is, for the UK economy overall, will it cool inflation? Will it hit growth? Will it stem the record level of jobs that seem to be created in the UK economy at the moment? Well, joining us now is the economist Simon French, who's the managing director of Panmure Gordon. Simon, it's good to be able to catch up with you. Thanks indeed for your time. What are your thoughts about going into 2022? What's the UK economy looking like in your view?
Well, thank you for having me on your show, Jeremy. So the first thing to say is I think you're right to put a 15 basis point increase from the Bank of England in its correct context, which is it's still well below where we went into the pandemic at 75 basis points. The Bank of England's balance sheet is twice the size it was at the start of the pandemic. By any historical measure, these are still very loose financial conditions. But what you are right also to pick up on is it's potentially the second order impacts that the Bank of England is concerned about, with inflation running at 5.1%. And it's trying to head off some attacks, perhaps on its credibility as an inflation targeting central bank, because that's quite an uncomfortable print. But overall, actually, the UK economy enters 2022, at least in terms of its fundamentals, as a job-creating, income-creating entity, in pretty rude health. Household balance sheets have more than 200 billion of additional assets versus the start of the pandemic. Unemployment down on a 1 month basis to 4.2%. That's a pretty healthy backdrop, even with the risks of higher energy costs and the risk of the Omicron variant.
Let's pick up on that point about inflation, if I can, because there's been this big debate in 2021 as to whether or not inflation is entrenched or whether it is just a flash rise and then a stark pullback. I noticed actually the Bank of England saying that they are talking about a peak around 6% in April. Do you think that this is an internationally driven number anyway? In other words, it's beyond the Bank of England's control. I'm talking here about oil prices, commodity prices generally. Or is it something that is actually represented by an increase in the amount of heat in the UK economy? And any interest rate rise will be sustainable because we have a good overall economic balance.
So principally, it is the first of those explanations. It is those exogenous factors beyond the Bank of England's control that is driving inflation, namely energy costs, but not exclusively energy costs. There are elements of domestic demand. There is a concern that pay awards will start to chase inflation higher. While I don't think we'll get, or any sensible economist thinks we'll get a price wage spiral of the type that we saw 30, 40 years ago. Central banks, the Bank of England included, need to be mindful that it doesn't want to embed higher inflation expectations that be costly, not just for all households, but perhaps most acutely for those with high parts of their disposable income allocated to energy, the elements that are rising fastest. The wisdom or otherwise of this decision may well hinge on what happens in April. When we're looking forward to 2022, what happens in April in terms of the energy price cap in the United Kingdom is so key to both the economic outlook and indeed the inflation outlook, because taken on current spot energy prices, you could see households facing a 40 to 50, and I'll repeat those numbers, a 40 to 50% increase in their energy price tariffs for domestic fuel. That would run coach and horses through any inflation forecast and really take a lot of the discretionary spending power away from UK households. It's such a big element that it dominates my thinking for the next 12 months in terms of the UK economy.
And of course, that would hit growth. The GDP number presumably then would then plummet. We were hearing a short while ago, I think it was the IMF, I think it was talking about maybe World Bank, talking about the UK being one of the fastest of the G7 in terms of growth next year. I mean, that, as you say, if it's going to run that coach and horses through the numbers, I guess we could well end up being one of the worse off economies in terms of growth. What are your growth forecasts for next year?
Yeah, so I've got 5.5% in for the year, which is predicated on the fact that the government will not and I think it's highly unlikely they will allow a full pass-through from spot energy prices through the energy companies through to households. I've been a pretty vocal critic of the energy price cap over recent years, but actually, paradoxically perhaps, when you have an energy price move of this scale, that is exactly when the state should come in and start to smooth the impact to allow households to absorb that. But overall, I do think those fundamentals, the household balance sheet of UK households, the overall performance of the UK jobs market makes me pretty content with a 5.5% growth forecast. But if we see energy prices sustained at this kind of level throughout the winter and into the spring, then clearly the risks start to skew up to the downside.
I noticed actually from most recent PMI data, we've got the service side of the economy, which of course is the largest part of the economy here in the UK, softening a little bit from the most recent data, manufacturing holding up. What do you think about some of these indicators for next year? Are you feeling relatively confident that we can continue to create jobs at the rate we've been creating them? I was listening as well earlier in the year. I think CBI was talking about something like around about 1 million jobs are out there at the moment. I think that's possibly almost a record high. Is that sort of job creation sustainable?
I don't think it's sustainable at the same sort of rate. I think one needs to acknowledge a couple of things that have been going on since the end of the pandemic. First of all, the huge success of the furlough scheme that protected 9 million jobs, 1 in 3 UK jobs, at its height back in Q2 2020. And successively, estimates for how much scarring, how many people would leave furlough and be on unemployment have come down and down and down as UK employers have shown great demand for any spare labour capacity they can get their hands on. The reason I think it will slow is, and you mentioned the PMIs, the dichotomy between the manufacturing and the services PMI. There continues to be a strong preference amongst households, which the Omicron variant is only going to accentuate, to buying goods rather than services. They can buy goods without too much of a health risk, particularly if you remain socially distanced from your delivery driver. But services is one of the areas where there is more of a health risk. What you're seeing actually is employers who are exposed to the goods sector, where consumer spending is red hot, are trying to just capture as many employees as they can to service that demand. It isn't yet clear that service-based economy are ready to give up on those employees. So you will get a bit of a loosening effect as that rebalances and stabilises. But actually, the UK labour market is, for all the other structural challenges the UK economy has been a glowing success story for about 15 or 20 years now. It's not a flash in the pan. And it's one of the real strong suits of the UK, its ability to create jobs almost wherever you need them.
Look, I appreciate you're not an epidemiologist, but we've got to talk about Omicron. What are you telling clients about the effects of this and how we should approach it in terms of an investment idea for next year in the UK economy, looking out of the broad scheme of things? What is Omicron doing at the moment, and what's it likely to continue to do into 2022? Is the advice you're being given is that we're going to get over it fairly quickly, or is this something that's going to become entrenched and we're going to have to live with it and it's just going to be some normal day-to-day life?
Yeah, it's a really good question. And first up, Omicron undoubtedly has started to soften the leading indicators of activity. It doesn't matter whether it's hotel, restaurants, travel bookings, mobility indicators, Google Mobility, credit card spending starting to show signs of softening and certainly rotating back to goods. But, and it is a but, if this variant is quite as infectious, and you're right to say I'm not an epidemiologist, but if it's very infectious but also very mild, there is a possibility that this is coming out of what will be almost certainly a mass infection of the population, a level of herd immunity that may well move the UK and indeed a lot of other economies towards endemic status of living with COVID-19, which ultimately was always the prize, either through natural immunity or through vaccine rollout. If you can get there very, very quickly and health services death rates are not overwhelmed, then actually a lot of clients I've been speaking to in recent days are saying, well, this is actually very much what we've been looking for. And you may well see the performance that we saw in equity markets, capital markets from about November 2020, when the first vaccine was announced, through to about April, when yield curves steepen, value starts to outperform growth, and you start to see a real rotation in capital markets. That is the thing that increasingly I'm advising clients to prepare themselves for, albeit that we, danger of caveating everything I've just said, we do need the data on the severity of Omicron for that thesis to play out. So we're not having investors going all in, as it were, but certainly positioning themselves for that possibility.
Just going back to your position with your client base and so forth, what are you saying about the next year in terms of how supportive the UK economy is going to be for investing? What's the outlook in terms of the atmosphere and the environment, I should say, for the stock markets? I think we were around about 6,500, I think, for the FTSE at the beginning of 2021. Here we are now, just around about the 7,250 level, going into the back end of the year. So it's been a pretty good run, I think, overall this year. We have been a little bit higher than where we are at the moment, going into the back end of 2021. So what are you saying to clients about the opportunities for the investment potential in the UK, bearing in mind what you've been talking about in the UK economy?
Yeah, I mean, most of my clients are bottom-up stock pickers, so they don't necessarily look at the index value. But from a perspective of a rising tide of sentiment lifting all risky asset classes, I think you do see further upside in the FTSE All Share. Why? Well, it remains a very, very keenly valued marketplace. At about 12 times on a cyclically adjusted PE, a 10-year cyclically adjusted PE, that's about, well, it's certainly lower than Europe at 16 times, and it is very much lower than the United States at 34 times. Now, the criticism or the challenge to that valuation thesis is, well, yes, but it's some people have called it a Jurassic Park stock exchange. Some people are calling it a 19th century stock exchange, given its large composition of ex-growth companies or ESG unfriendly companies. But actually, even if you control for sector composition, there's a very visible scarring effect of the last 5 or 6 years of underperformance. And I do think as Brexit increasingly moves into the rearview mirror, as the UK economy moves out of COVID potentially to an endemic status, I do think there's more upside on a valuation grounds that is justified even once you take into account sector composition.
So this idea that I'm hearing from a lot of fund managers that the UK is undervalued compared to other Western markets holds true.
Absolutely holds true. The problem, of course, is that that is not a new phenomenon. It has held true for about 4 years, 4 or 5 years, actually. In Q2 2016, which was when the Brexit vote took place, UK equities were higher valued than their global benchmark. There has been about a 25% devaluation relative to global equities over the subsequent 4 or 5 years. And that gap still exists in large part today. So the frustration, if you like, for UK-focused investors is they can see it. It's very obvious in the data. I'm not the only one talking this story. It can be seen for anybody who studies the valuations almost across the valuation suite you pick. But you do need a trigger event, a catalyst, in order for liquidity to come back into a market where liquidity has been pretty thin and sentiment to start to come back in a more positive sense. What that catalyst will be, with the greatest respect in the world, I probably wouldn't be here if I knew that, having this conversation. But I do think that when you look at a deeply liquid asset class like UK equities and you see a persistent undervaluation, that remains for many investors an attractive proposition because some catalyst will eventually come along and challenge the idea that you, or an international investor, have to be underweight in the UK.
Just very quickly going back to the UK economy again, and the Bank of England particularly, taking us back to where we started, where do you see interest rates at the back end of 2022?
Well, I'm really pleased you asked that because the markets have about 4 rate hikes penciled in. And if you look at the curve for 2022, I think that's too rich. I've been pretty public in saying that. A lot of my written commentary has said that looks mispriced to me. Yes, the Bank of England have become the first of the major central banks to raise its interest rate, but Do I think it's going to follow up with 100 basis points of increases next year? No, I don't. It remains one of a cautious, iterative approach because of the factors you mentioned earlier in this interview about the fact that a lot of the inflation forces are agnostic to the Bank of England's base rate. So I think 2 rate increases feels about right to take us back to 0.75%, which is where the UK economy entered the pandemic. And remember, of course, it'll still have a balance sheet that is twice the level it began the COVID-19 pandemic. So still, on an absolute basis, very accommodative financial conditions, but we think 2 rate increases rather than the 4 that the market is currently pricing.
Interesting, Simon. Look, we'll leave it there, but thanks indeed for joining us. Have a great Christmas and New Year. Looking forward to speaking to you again sometime in 2022. That's Simon French. He's an economist and the managing director of Panmure Gordon. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.